Let me ask you something. How many times have you stared at a chart, seen a breakdown, and thought this stock is going lower, only to get completely faked out? It happens to the best of us. That's why today we are cutting through the noise and diving into a technical indicator that actually matters: RSI, MACD, stochastics, volume, and showing how you can use them to spot a real bearish setup. What could be that particular option strategy? And what if you could structure a smart bearish trade that profits from a gradual decline rather than all out crash? That's where the put calendar spread comes in, giving you an edge with volatility, time decay, and risk defining position. So buckle up, because today we are decoding the signals behind the stock breakdown and walking you through a professional grade bearish trade setup. Let's get into it. Again, good morning, everyone. This is your host, Zoheb. So let me bring my screen here and then walk into this particular details. As you can see my screen here, I'm going to pick any of the bearish trade. Workday came into our attention. Its rising trend lines a signal that often precedes further decline. Again, you might ask, what is trend lines? Trend lines providing guidance for a chart trader, showing where likely turning points in price. When a stock breaks below its trend line, it's worth noting it means that the prior established order is no more. New things to come, a downward break indicators more selling to come usually. But try not to rely on the trend lines alone. Several other technical indicators are flashing. And what are they? I've gone into this particular SensaMarket here, gone into the trade here, and then I've selected the company, Workday, 241 trading at that particular stock. I've added the indicators from right here. So already added RSI, MACD, stochastics, and everything. So let me bring this RSI here, and then let's jump into that. RSI, again, while not extremely significant, Workday's RSI has dipped below the neutral 50 level, as you can see here, indicating the increasing selling pressure. Moving average convergence divergence, which is the MACD over there right below that, MACD line has also crossed below the signal line, that pretty well respected bearish signal, suggesting not price but momentum is shifting downwards. The stochastic indicator, which is right below there, which is added over there, the oscillator has moved out of the overbought territory and is trending downwards, reinforcing the bearish sentiment. The volume, which is right over here, there's been an uptick in selling volume as the workday broke its trend line, indicating that the bears are gaining control. These indicators collectively paint a picture of this particular stock transitioning a downward trend, or as they might say, implementing an adaptive negative scaling methodologies to recalibrate the ecosystem dynamics. Let's go into this particular details here. Again, broad market context. If I just have to bring up this SPY, as you can see, you're in zooming out, the SPY is transitioning from this is coming low. It has gone from getting a little itchy to kind of like pissing the bed territory. We aren't all the way down to 10%, but correction, but we are getting there. Breaches of that particular level can lead to heavy volatility. And institutional selling and bearish spirals. So keep an eye on the S&P and the NASDAQ. If they go, everything goes. So you might ask, what would be a good option trading setup here? And let me bring this particular screen here. And again, picked up Workday, and this setup here is going to be a short calendar put spread. The bearish, given the technical breakdown and the supporting bearish indicators, let's explore this particular trade from a gradual decline of this workday. And I can pick any of those bearish particular strategy or a strike and a put calendar spread. So establishing this particular strategy as a bearish position with limited risk, and you are capitalizing on a slow move lower. The trade setup here, before I jump into that, so SensaMarket.com, you can go to the option strategy. I've selected the calendar put spread. It's also the short calendar put spread. You can also explore all this particular strategy from the left navigation right over here. So workday trading around $241. So this particular strategy is a setup of selling a put position on lower month, April, somewhere around April 25th, I picked there. You're selling that, and you are buying a put position, which is the buy showing here, on a date which is higher than particular April what you selected. I'm selecting June 20th. So what happens in this particular case? So you are betting that this particular strategy, if the workday for this in this case falls below this particular break even, which is 245, you will be making profit in this particular green zone. And the green zone ends somewhere around 183, and if it is goes beyond that, you will be at a loss. Again, if you are going into this, if stock goes more than 245, then you'll be at a loss. Again, you might ask why this calendar spread. Implied volatility discrepancy. Our near-term option have slightly higher IV than the long-term ones. So a calendar spread allows you to sell high IV and buy a lower IV, potentially profiting from the IV differential. The trade is also a Vega positive. As you can see on the right side, as I'm bringing up my mouse, you can see all the Greeks value, delta, theta, gamma, Vega, and rho. The Vega here is a positive, meaning that it's a sell-off materializes, then we can benefit from the increased overall volatility. Time decay advantage. The trade is more or less theta neutral until it moves slightly in your direction, at which point it becomes a theta positive, which is always nice. Limited risk in this case. You're betting in this particular strategy, trading around for, in this case, the net code $4.13 multiplied by 100, somewhere around debit of 412. So the maximum loss in this case is also capped at the same 412. So it's a defined risk. A rapid decline or an unexpected rally in the workday stock price could diminish the effectiveness of the calendar spread. As the strategy benefits from a gradual price movement, this would still yield a winning trade, just not a grand slam. Implied volatility changes. Significant shifts in IV could impact the spread's value, particularly in the IV decrease substantially. As we spoke about the risk, reward, and the probability, again, it's a defined maximum loss in this case, which is the debit position. The exact profit potential isn't possible to calculate due to IV and the time decay being dynamic and the variable in the back month. In break-even point, again, tricky to calculate at this point of time. Again, you can go into this particular here, and then you can see that even though the strike prices at the expiration could look profitable at this particular case, but if you are able to sell this off at a different particular date or the strategy, how your profit loss potential would look like. And that's what this particular green graph is going to show as you change those days remaining, or you want to sell that off at a expiration date well before your full expiration thing. Stop take profit level using a 50% retracement back in the channel, somewhere around 243 would be a fair stop loss, and somewhere around 183 while far away seems a reasonable level to take profits. You might ask, again, this has worked as an example, when exactly to use this particular strategy, a put calendar spread. Again, anticipating a gradual decline, you expect the stop decline slowly over time rather than plummet rapidly. Implied volatility skew. Near-term option exhibit higher IV than a long-term options, providing an opportunity to capitalize on the IV discrepancy. While this isn't the case here, the entire trade is long volatility. So we are allowing ourselves to advantage of continued broad market decline. In a sense, two bets at one under rise in the market volatility. You seek a bearish position with a limited risk and the known risk in this particular case. So let me bring myself back, and then let's wrap this up. Again, in today's analysis, bearish trade setup and a put calendar spread. Again, no strategy is foolproof, and it's essentially aligns any trade with your risk tolerance, market outlook, and everything. Stay vigilant, keep learning, trade safely, and allocate responsibly. Thank you all.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.